Okay, so for those of you that joined our live this past week, which would have been May 4th, I apologize. We had some technical issues, and they were all my fault, I am sure. So we're going to re-record this right here. So I have Cassie with me from Southeast Mortgage because most of the questions we got this past week were driven to lenders, not necessarily me. I'm your agent, not your loan officer. So, Cassie, the first question that we got was port mortgaging, like taking a mortgage from your current home and porting it to a new home to retain the interest rate that you have on your current home. And I think it is called port or portable or porting. If you can explain that, pros and cons, anything that you want to give us on it.
Okay, great. So yes, there is such a thing as a portable mortgage. It's done through a lender who has that closed the loan, serviced the loan, stays with that lender. You can make alterations to it with that lender. But after further digging, I realized that in the United States, it's not an option. That most of the information that you're finding out online is driven because Canada actually allows it because they have a universal titling system in Canada. They do not have that here. So each mortgage is tied to a specific property here in the United States, and it cannot be ported to a separate property.
Interesting. So, and this is a side note, and you might not know the answer. Does Canada have like a lot higher interest rates than we do in the States, or do you know?
They do, and their mortgages are set up a lot differently. They don't
Okay.
they don't ever refinance. They pretty much stay in the mortgage that they're in for many, many years.
Huh. Okay. Interesting. All right. So our question number two is cash out refis. So basically, this person was saying we know already a lot about a HELOC loan, which you can elaborate on a little bit for those that don't. But is a cash out refi different, the same? What makes one better versus the other? How are they different?
Perfect. So a HELOC is it's a separate mortgage of types that you can take out of the equity of your home. And HELOCs let you take out a certain percentage of the equity that you carry in the home, but you have to keep your 80% LTV, but you can take out a little bit. It's usually about $30,000 or so, depending on how much equity you have, right? And you pay it separately than your mortgage. So you keep your same mortgage payment that you have now, and this is an added debt to you. Now, when you go to sell that home or refinance that home, the HELOC has to be paid off. It's like a lien or so on the backside of your current mortgage. With a home equity line of, with a cash out refinance, you're actually changing the terms of your loan. So let's say if you're 10 years into your mortgage, you are taking that mortgage and you can do a 20-year cash out refi, or you can spread it across 30 years again to make it a more affordable payment. You're allowed to take out up to 80% loan to value on a cash out refinance, and it would be based on the new value of the home. So if you bought it for $300,000, it might be worth $500,000. So you've got $200,000 of equity sitting there that you can take out. With a cash out refinance, you do get a new interest rate. You will not have the same interest rate unless you can use some of that equity to buy down the rate so you could get yourself back closer to where you were. Or you could be coming down from a higher rate. I mean, those are the best when you're lowering the rate as well. Cash out refinances work when you are able to lower the monthly debt, outgoing debt. So even though you might be paying a higher interest rate, if you are paying off a good bit of debt that's much higher interest, it can actually be less outgoing payment per month. Those are we have to make sure that a cash out refinance makes sense for the buyer, or we cannot do them.
Right. And I know a lot of our clients, when they're doing the cash out refis, it's usually to put in a pool, do like upgrades to a property, or to pay off debt. There's not really another reason that I can think of. I mean, maybe if you're going to take that money and buy an investment property or a second home, but for the most part, that money is going to be used, at a higher level than if you were doing a HELOC and you just need 30,000 just for a kitchen remodel or something like that. So definitely you would use the two sometimes for the same thing, but often it's going to be much more money in your pocket from a cash out refi.
Correct. Correct.
So, okay. Well, that is it. That's what we were able to cover with the bad technology last night. So we will get this out to everyone. Cassie, thank you for joining me. And I apologize. I was just in a bad area. I was in Stockbridge. I don't know.
No worries at all. I love coming on with you.
All right. Thank you.
All right. Have a great day.
You too. Bye.
Bye.